Hi class, in this video we're going to look at an example from chapter 27. So this one says in April 2019, Metal Trailers Company had the following cost data, and we've got some information about raw materials, some labor costs, some overhead costs, and some other information. And then it says we have three requirements in an analyze. Prepare general journal entries to record each item of cost data. We got to compute the overhead that was underapplied or overapplied, and then we got to prepare a partial income statement for April. All right, so the first thing we're supposed to do are our journal entries. So this is prepare journal entries to record each item of cost data given. Excuse me. So we're going to start with A. We're going to record our raw materials that were purchased. And we're to assume they were purchased on account. So that's an accounts payable and raw materials inventory. And it said it was $93,000. I'll record the cost of direct and indirect materials used in April. So I'm thinking it's supposed to be up here. We've got direct materials of $85,000 and indirect of $5,000. So that's item B. So basically what we're recording is we're taking $85,000 and $5,000. Let's just do it this way. $85,000 and $5,000 out of raw materials, so that's $90,000 out of raw materials. So let's go ahead and put that in here. And we're putting that raw materials into production. So $85,000 of that is direct materials, and that goes in work in process. The other, the $5,000 that was indirect cost, goes into overhead. So that is right there. So that's all there is to letter B. Records the cost of direct and indirect labor for the month. All right, so that looks like number C or letter C. We've got factory wages of $60,000, and of that $60,000, $55,000 was direct, $5,000 was indirect, and then we've got some Social Security taxes, Medicare taxes, and federal income taxes. All right, so back in Accounting 120, we did some payroll transactions, and or whoever you had probably told you to debit your gross earnings to start with, and that's your expense, and then you're going to credit all of those withholdings and the amount that's payable to your employees, which would be the net pay. So we're going to start with the gross pay, and in this case, the gross pay is broken out into two categories, direct and indirect. So the direct labor goes directly into the work in process. The indirect goes in manufacturing overhead, and that's the same as the raw material indirect cost. It's just all going into that manufacturing overhead. So we had $55,000 in direct labor, and I think it was $5,000 in indirect labor. So that's our gross pay. And those are our debits. So the next thing we're going to do is we're going to credit all of those withholdings that we had. So I think there was a Social Security withholding and a Medicare and income tax. I think that was it. Social Security, Medicare, and federal tax deduction. So we're just going to plug those amounts in directly down here into those payable accounts because we actually owe those to the government. So they're going to come down exactly like they were in the instructions. All right, so now our debits and credits are out of balance. So I always like to think of this entry as like a paycheck stub. So if you look at your paycheck stub, you've probably got some gross earnings. They take some stuff out, and then you get what's left, which is your net. This journal entry works kind of the same way. So we've got our gross earnings. This is the stuff we kept out of the employees' paychecks. So the difference between what they earned and what we kept out is their net pay. So if we take those debits and subtract the credits out, we can get the net pay, which is $46,410. And that net pay is something that we owe our employees. It's an expense that we owe our employees, or a liability that we owe our employees. So that's salaries and wages payable. So that entry is finished now. The next one says record the overhead cost during the month. I bet that's D, and it is. It says other overhead costs of $29,000 were incurred. It says to credit accounts payable, so we haven't actually paid those yet, but we never going to. So I'm going to credit accounts payable for $29,000, and the debit of $29,000, since this is indirect, goes to manufacturing overhead. Five says record the overhead applied at 75% of direct labor cost. All right, so our direct labor cost was $55,000. So if we had direct labor cost of $55,000, and we're applying overhead at 75% of that, we're going to take the direct labor of $55,000 and multiply that by 75%, and that's going to tell us how much of that overhead that we are applying. And so if you do that, that calculation actually comes up to $41,250. And that's the amount of overhead we're applying. So on these previous entries, we've put our indirect cost into the manufacturing overhead account by debiting it. So we're going to take it, we're actually applying that. So we're taking it out of manufacturing overhead. So we're going to credit manufacturing overhead, and we're going to apply it. In other words, we're going to put it dump it into work in process inventory. And then the next one says record the cost of jobs completed during the month. So this says finished goods costing $150 were transferred from production to the warehouse. So that's what you've completed, $150,000 worth of stuff. So I need one more zero there. All right. So for us to transfer, we actually have finished $150,000 worth of stuff. That stuff that we finished started out in work in process. We've been putting all these expenses as we manufacture stuff into work in process inventory. Here we're going to take it out of work in process and put it into finished goods. Those are both asset accounts. So to take it out of an asset account, you credit, and we're going to put it into finished goods inventory, which is an asset, so you debit. Number 7 says record the cost of goods sold for April. And that's just an amount they gave us. Cost of goods sold was $110,000. All right, so when we actually sell stuff, we take it out of finished goods because that's an asset, that's our inventory. So when we sell it, we don't have that inventory anymore. So we're going to take it out of finished goods, put it in cost of goods sold. Then the last one says record the sales on credit, and I think they just gave us that amount too. Sales on account for the month were $220,000. And that's on accounts, so that's accounts receivable. We're going to record our sales revenue, also for $220,000. All right, so let's check and make sure we're on the right track. And that Connect's not going to do something quirky like it's been doing lately. All right, that looks good. So that's what yours is going to look like. You should have an entry for each one of these amounts. And let's see, requirement 2 says, compute the amount of overhead applied or under-applied for the month. So we're going to go to requirement 2, and we've got a little chart. And the first section is manufacturing overhead. So manufacturing overhead consists of indirect materials, indirect labor, and any kind of other overhead costs that we had. All right. You can go back up here and you can kind of pick those out, but I think we've got them all in these entries over here, so it might be easier to do that. So we've got indirect materials going into manufacturing overhead, which is right here. That was that $5,000. Down here was the labor. That was another $5,000. And then we had that other manufacturing cost of $29,000, and that's actually what they call it up here, other overhead cost. So if you take those three categories, either from the instructions or you can look at the journal entries that you just did, we've got $5,000, $5,000, and $29,000. So our total charges to manufacturing overhead were the $39,000, and that's what we put in a manufacturing overhead in our journal entries. But we took some out because we applied it. And that manufacturing overhead applied, if you remember, it was the 75% of direct labor cost. Let's see. It was this entry right here, E. We took $41,250 out of manufacturing overhead. That was where we applied our overhead. So let's go back over here to requirement 2, and we're going to put in the amount we applied. All right, so our actual manufacturing overhead was $39,000. We kind of took a guess, ballparked what we thought we would have, and applied some amount of the overhead based on estimates that we think it cost us about 75% of our direct labor cost in overhead. So we applied that estimate. So we weren't exactly right. It actually cost us $39,000, and we applied $41,250. So we actually over-applied the overhead. In other words, we charged too much to work in process inventory. So we've got this over-applied amount right here. So that's requirement 2. Requirement 3 says, prepare a partial income statement. Oh, and then it says, adjust the cost of goods sold for over-applied or under-applied overhead. So let's go to requirement 3. And we've got a little bit of a blank income statement. So, you know, we always start out with sales. And I think that was the last entry we recorded. Sales, $220,000. And we're going to, they've got, I mean, usually we put a little bit more detail, but this one you're just going to subtract out your cost of goods sold. Let's see, where was that? Maybe the second to the last one. Yeah, right here. Cost of goods sold is $110,000. All right, and then the instructions said to include the over-applied or under-applied overhead. So we actually had, we had over-applied overhead. So we have too much overhead in that cost of goods sold because we applied too much to our work in process, which then filtered down to our finished goods and then cost of goods sold. So we over-applied it, so we have too much in that cost of goods sold. So we're going to subtract out the over-applied because it really shouldn't be in there. We just overestimated. So our cost of goods adjusted to actual is just the difference between those two, which is $107,750. And it adjusted the bottom line for us, so that's our gross profit, since it's a positive. see how we're coming along now. Yeah, so this one should look like that. Didn't actually check requirement 2, but requirement 2 should look like that. And I think that leaves us with everything done except the analyze. So the analyze says, based on the partial income statement you have prepared, what portion of each sales dollar is realized as gross profit? All right, so we're at our income statement. So what portion of each sales dollar is recognized as profit? Well, let's see how we can figure that out. All right, so they're basically asking for a percentage of gross profits over sales. In other words, what percentage of gross profits is it of sales? So just take your gross profit on sales, and mine is $112,250. Divide it by your gross sales, and mine's $220,000, and that should give you how many pennies on the dollar. It says round it to 2 decimal places, and mine's 0.51. So your answer should be somewhat formatted like that. It probably isn't going to be the same amount, but let's see if that worked. Yeah, so yours will be like that. All right, so I think this one's done. Oh, answer is complete and correct. So yes, this one's done. The other questions from chapter 27 are similar to this one. Most of them are a lot smaller. They generally are like a piece or a portion of this particular problem. So I thought we'd do the long one, and you can kind of use it if you get stuck on the little ones, because they're going to follow the same process. They're just going to be a smaller piece of this problem. So anyway, this is helpful. As always, if you have questions, comments, concerns, feel free to let me know, and I will try to assist.